Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion we will be talking about something that you probably have in your pocket right now, or at least very close by, and that is copper. Copper futures are something that we can trade as traders, and as such we thought it was important to cover it as one more base to make sure that you're fully prepared and have all the information that you need to pass that Gauntlet Mini. It is going to be a tricky challenge in order to pass, so I want to make sure that we cover every aspect of information from trading strategies to just what contracts there are available to you, and that is where this category falls. So we're going to talk about all of the copper futures details, how it works, where you can find it, and all of that good stuff. But before we go any further, please do me a favor and click that like and subscribe button down below. That way I can keep coming out with content for you guys and give you that push you need to pass that Gauntlet Mini. Now let's get going. It should be of no surprise that copper is a common metal with a wide range of applications across multiple industries. Mining companies and distributors often use copper futures as a hedge against any losses that might come as a result of price changes. However, these contracts are also popular among speculators like us looking to profit off of those same price changes. Copper futures are traded across major exchanges, as you might expect, being such a highly sought-after product. The market's trade volume has been on the rise over the years as both retail and institutional investors are trying to tap into this market that is just very, very diverse, dynamic, and sought after. By definition, copper futures are a standardized contract in which two parties agree to buy or sell the copper at a future date for the current price. A person going long on the contract agrees to purchase a certain quantity of copper at a predefined date and price. The person going short has an obligation to deliver and sell it at the specified price on the contractual date. Let's imagine an example so we can understand really how this works. If we were to say that we had two people that were agreeing on a trade with, say, 25 tons of copper futures on the London Metal Exchange, that means that what's going on here is for delivery, there needs to be 25 tons of copper at the due date of, we'll say, hypothetically 3 months by the seller of the buyer's request. In most cases, the contract rarely goes this far because usually traders are going to settle the trade with an offsetting position or a cash-based settlement. Most people aren't looking to actually take delivery of 25 tons of copper. Using the London Metal Exchange, otherwise known as the LME, this is what some contract specifications around a copper futures contract might look like if you go searching. Once again, this is on the LME. The contract code is CA, so relatively simple there. CA is going to be your copper. Then we have the underlying metal of what's actually being traded, and this is a category of copper called grade A copper. We have a lot size of 25 tons. That is the size that the contract represents, and that is what we were talking about. If the seller actually has to make delivery to the buyer, this is what they're going to give them for each contract that has been purchased. Then we have the price quotation, which is done as US dollars per ton. US dollars per ton is how we're going to understand what the price is doing as it's going up and down relative to copper. And the clearable currencies that we can use are going to be US dollars, Japanese yen, and sterling, as well as the euro. So sterling we know is the British pound for those of you that are a little bit unfamiliar with the Forex world. But what we have is a situation where it is going to operate and look quite a lot similar to just about any other futures contracts that we might be trading already. As we mentioned, copper is definitely an important and sought-after metal. The demand for copper is often analyzed to determine an economy's overall health. Many investors keep a portion of their portfolio in metals like copper as another way to diversify. In most cases, copper provides a less volatile option for traders to trade. By entering into a futures position, the trader can then take a leverage contract instead of buying the metal's equivalent amount. They have to pay an upfront initial margin, of course, at the exchange and ensure that the maintenance margin level is not breached. Copper futures are a crucial financial instrument for companies involved in mining the metal. By entering into a futures contract, these companies can lock in a price for selling the product and remain insulated from any price fluctuations that might arise. Copper is a metal that finds its application in just so many industries, as we're all aware. It's commonly used in things like housing construction, electrical wiring, consumer products, and even industrial equipment. Any surge in its price can make all of those products thereafter far more expensive. Therefore, businesses buying copper enter futures markets and lock in a buying price for that metal ahead of time. The drawback of this kind of a position is that if price falls, the manufacturer will not have the opportunity to benefit from this reduction. By locking in levels at a fixed rate, though, these manufacturers can focus on their core business and not worry so much about the price as it moves up and down. We can break down the people that trade copper into three main categories. The first category is the mining companies. These companies have a direct interest in copper prices since their bottom line is directly tied to them. While mining companies can somewhat control the supply, demand plays an important role in determining the price and making the price volatile or not. Large mining companies have specialized finance functions that play an active role in this futures market in order to make sure things stay stable. Then we have the manufacturers. This category is mainly companies that require copper as an input material. Earlier manufacturers were purely involved in their own core business without ever intervening in the financial markets, but nowadays the market's flexibility and instability provides a certain degree of desire and control to be exercised by the manufacturers of those that are using copper as an input material. And finally, we have the investors. This is the category of us as speculators. Now, investors like us are necessary for building and maintaining liquidity in the futures market. We can have several different motives as traders as to why we might be trading, but the end goal is really quite simple. Us as speculators and investors are looking to gain value based on the rise in the price of something like copper, or potentially even by gaining value in betting on its collapse. Pretty much all of the copper futures that are traded in the world are traded on either of these three exchanges. We have COMEX to start us off. This is the commodity exchange, otherwise known as COMEX. It's part of the CME group, and it offers a wide range of derivatives products on many different kinds of commodities. The CME group is, in fact, the marketplace offering the most diverse offerings when it comes to derivatives. A standard copper futures contract here comprises of 25,000 pounds of copper in weight, and the price is quoted in US dollars. COMEX has also introduced E-mini copper futures, which allows traders to opt for a 12,500 pound contract instead of that standard 25,000 pound contract. The smaller size allows retail traders to enter into the market and add their liquidity without needing a very large amount of money. Next, we have the London Metal Exchange, otherwise known as the LME. The London Metal Exchange is the second most popular exchange for trading commodities. It's a crucial venue for trading copper futures amongst obviously many others. This is primarily because most of the consumption and mining of copper occurs outside of the US. This is the preferred marketplace for traders looking for an opportunity outside of the US, that is the London Metal Exchange. Now, compared to COMEX, the LME has a contract with an underlying weighing value of 25 tons for each futures contract, which is equivalent to an E-mini futures position on the COMEX marketplace. And finally, we have the multi-commodity exchange. The first two names on this list that we were talking about, COMEX and LME, have been dominating the derivatives marketplace for quite some time. But other exchanges have been popping up and gaining popularity amongst investors, and one of which, arguably leading that off-brand pack, is the multi-commodity exchange, otherwise known as MCX. This is a platform that is based out of India, and it was established in 2003. It has recently developed into a very mature mature market for copper futures. The standard contract size here is a size of 1 ton or approximately only 2,200 pounds. A mini contract, by example, is a quarter of the size of the standard contract here, so the multi-commodity exchange provides a place for traders to trade even smaller than what is offered on COMEX or the LME. With this chart, it helps illustrate what really is moving the price of copper in terms of demand. And looking at the copper usage, at least in the US, we can use this chart to see that building construction contributes to 43% of overall copper usage inside the US. Other sectors have a direct bearing on the general health of the economy as well. And for copper's price to trend upward, the demand of this overall pie chart needs to be sustained in the sectors that we see here. The idea is simple, that if the transportation, building industry, electric and electronic products industry, as well as the consumer and general products area and the industrial machinery equipment sector, if all of these sectors are doing well, or we can consider all of these sectors as growing sectors, if they are growing, then we can also expect to see an increase in the price and demand of copper. The supply and demand concept here is relatively simple, and if we are looking to get involved with trading copper, these are the things that we want to become a little bit more familiar with on an intricate level, especially the building construction category, as it accounts for, once again, 43% of all demand for copper inside the US. In summary, copper is something that we all were already aware is used quite a lot around the world on a daily basis, and that should allude to the fact that there would definitely be some type of trading market available for copper from both investing standpoint as well as those looking to hedge their copper-based industries. Copper is a very liquid market, and it is consistently growing over the years, which bodes well for those of you that are looking for another commodity to become involved with, another asset to become familiar with, and another source to find that technical analysis in the market and get an idea of where something might be going. If you focus on all of the price movers that we discussed, and you become more familiar with the yearly cycles of when demand is higher and when demand is lower, trading copper can become a very powerful asset in your trading arsenal. Until next time, thank you for joining me. As always, folks, I wish you the best of luck on your Gauntlet Mini journey. I will be there right when you finish. Cheers, folks. Over and out. Bzz.